Welcome back to Mr. AG, Asian Guy. I've been doing this long enough to recognize when we cross a threshold that cannot be uncrossed. There are moments in markets when the rules change, when the game that everyone has been playing suddenly reveals itself to be something entirely different than what the players believed. January 14th, 2026 was one of those moments. Silver breached $94 per ounce. Let me say that again because I want it to sink in. $94. 1 year ago, silver was trading at $37. 12 months, a 150% increase. The mainstream financial media is calling it a rally. They are calling it a surge. They are throwing around words like unprecedented and historic as if they understand what they are witnessing. They do not. What happened on January 14th was not a rally. It was a revelation. The silver market just told the entire world that the system we have been living under, the system of paper promises and fractional reserves and unlimited leverage, that system has a fatal flaw. And the flaw just became visible to everyone with eyes to see. Today we are going to do what this channel exists to do. We are going to peel back the layers. We are going to show you the 5-year journey that led to this moment. We are going to explain why Peter Schiff is warning that major US banks could crack. And we are going to reveal why $94 is not the end of this story. It might just be the beginning. So if you are new here, welcome. You found the right place at the right time. Hit that subscribe button because the information we cover on this channel is not available in the mainstream. And if you have been here for a while, you already know what we do. We connect the dots. We see through the noise. Now let us begin. The $94 breach did not happen in a vacuum. It was the culmination of 5 consecutive years of structural deficits in the silver market. 5 years. Let that sink in. Since 2021, the world has consumed more silver than it has produced every single year. Not by a little, by a lot. The cumulative deficit over these 5 years has reached approximately 820 million ounces. To put that in perspective, global mine production is around 800 million ounces per year. So the deficit that has accumulated is essentially an entire year of global production. That silver is gone. It was consumed by solar panels and electric vehicles and smartphones and data centers. It was absorbed by India and China. It was pulled out of COMEX vaults and LBMA vaults and shipped to the east, never to return. The vaults that are supposed to back the paper contracts that trade on these exchanges, those vaults have been drained to their lowest levels in decades. And here's the part that should terrify anyone holding paper silver. The paper market does not care about physical reality until suddenly it does. For years, the game continued because most participants were content to trade paper. They did not want the metal. They wanted the exposure. They wanted the leverage. They wanted to bet on price movements without ever taking delivery. But what happens when the music stops? What happens when enough participants look at the vaults and realize there is not enough silver to satisfy all the claims? What happens when industrial users, who actually need the metal for manufacturing, start to panic? What happens is, January 14th, 2026, what happens is $94 per ounce with no ceiling in sight. UBS just released a projection that stopped me cold when I read it. They are forecasting a 293 million ounce supply gap for 2026 alone. Not cumulative, just this year. 293 million ounces. Demand is projected to hit 1.34 billion ounces. Supply remains flat because it cannot respond. And this brings us to one of the most important concepts you need to understand about the silver market. It is called the byproduct trap. Unlike gold, which is typically mined as a primary product, approximately 70 to 80% of silver production comes as a byproduct of mining for other metals: zinc, copper, lead, gold. Silver comes out of the ground alongside these other metals, and the economics of the mine are driven by those primary products, not by silver. This creates a bizarre situation. Even when silver prices surge, production cannot respond proportionally. If copper prices are weak, miners are not going to open new copper mines just because silver is high. The capital expenditure required to develop a new mine is measured in billions of dollars. The lead time is measured in years, sometimes a decade or more. You cannot just turn on the taps. The supply side of the silver market is structurally inelastic. It does not respond to price signals the way a normal commodity would. This is the trap. Demand is surging because the world is electrifying everything. Solar panels need silver for the electrical contacts that make them work. Electric vehicles need silver for battery management systems and sensors. Every smartphone, every laptop, every data center server uses silver because no other material matches its electrical and thermal conductivity. The green revolution that everyone is cheering for is a silver consumption machine. And the machine is hungry, it is getting hungrier, and the supply cannot keep up. This is why the deficit has persisted for 5 years. This is why it is projected to get worse. This is why $94 might look cheap in hindsight. Now I want to talk about something that should keep every banker on Wall Street awake at night. Peter Schiff recently gave an interview where he laid out the mathematics of the situation in terms that anyone can understand. And the mathematics are terrifying. Annual silver production is approximately 800 million ounces. The banking system is short approximately 4.4 billion ounces. Let me repeat that because I need you to understand the magnitude of this imbalance. Production 800 million ounces per year. Short position 4.4 billion ounces. That is a ratio of 5.5 to 1. The banks have sold 5.5 times more silver than the entire world produces in a year. How is this possible? It is possible because of fractional reserve lending applied to commodities. It is possible because of a system where paper promises are treated as equivalent to physical metal. It is possible because, for decades, nobody called the bluff. But what happens when silver is at $94 and climbing? What happens when industrial users are desperate for physical metal? What happens when China has locked down exports and the vaults are draining? The short sellers have to cover. And to cover, they have to buy. And when you are short 4.4 billion ounces, and there are only 800 million produced each year, the mathematics become a death spiral. Every ounce the short sellers buy to cover their position pushes the price higher. The higher price attracts more attention. More attention brings more demand. More demand means less available supply for the shorts to buy. The price goes higher still. This is the squeeze that Peter Schiff is warning about. This is why he says major U.S. banks could crack. The exposure is not hypothetical. It is not theoretical. It is sitting on their balance sheets right now, metastasizing with every dollar the silver price rises. And the banks cannot simply walk away from these positions. They are contractually obligated. They have counterparties who are owed silver or the cash equivalent. As the price rises, the losses mount. And at some point, the losses become existential. Now, I want to put this in historical context because the mainstream media keeps comparing this to the Hunt brothers squeeze of 1980. They are wrong. The comparison is superficial at best and misleading at worst. In 1980, the Hunt brothers tried to corner the silver market through speculative accumulation. They were buying futures contracts and taking delivery, attempting to control enough of the supply to dictate prices. The COMEX changed the rules mid-game, implementing liquidation-only trading that forced the Hunts to sell. The price collapsed from $50 back to $10. The Hunts went bankrupt. The moral of the story, according to Wall Street, is that you cannot squeeze the silver market because the exchanges will change the rules to protect themselves. But 2026 is not 1980. The fundamental drivers are completely different. This is not a speculative corner. This is industrial consumption. This is solar manufacturers who need silver paste to build panels. This is Tesla needing 25 to 50 grams of silver per vehicle for batteries and sensors. This is NVIDIA needing silver for the GPUs that power artificial intelligence. These buyers are not speculators who can be shaken out by rule changes. They need the metal to run their businesses. If they cannot get silver, they cannot build products. If they cannot build products, they go out of business. That is a very different dynamic than a speculator trying to corner a market for profit. The COMEX can change the rules all at once. It cannot conjure physical silver out of thin air. It cannot force solar manufacturers to stop needing the metal. It cannot make the deficit disappear. This is the key insight. In 1980, the squeeze was artificial. In 2026, the squeeze is structural. Artificial squeezes can be broken. Structural squeezes have to run their course. The course for this squeeze is higher prices until demand is destroyed or supply materializes. Neither of those outcomes is happening anytime soon. Now let us talk about China, because what happened on January 1st, 2026 changed the game permanently. China implemented strict export licensing requirements for silver and other critical minerals. This was not a complete ban, but it was a massive restriction. Only approved entities can now export silver from China, and approval requires meeting stringent criteria set by the government. Why does this matter? Because China controls a dominant share of global silver refining and processing capacity. Much of the silver that ends up in Western vaults was refined in Chinese facilities. By restricting exports, China has effectively turned off the spigot that was feeding the global supply chain. The metal stays in China. It gets used by Chinese solar manufacturers. It gets stockpiled in Chinese strategic reserves. It does not flow to London. It does not flow to New York. The announcement on January 1st was the catalyst for the final surge to $94. Traders looked at the supply chain and realized that a major source of refined metal had just been cut off. The scramble for physical delivery intensified. The vaults drained faster, and the price exploded upward. But China's move is not just about supply. It is about geopolitics. Silver has been reclassified from a commodity to a strategic material. It is now in the same category as rare earths. Beijing is sending a message. In a world of decarbonization and electrification, the nations that control critical minerals will have leverage over the nations that do not. China is not going to let its domestic industries be starved of silver just so Western companies can build solar panels and electric vehicles. The West is waking up to this reality, but the response will take years. You cannot build refining capacity overnight. You cannot open new mines on a political timeline. The infrastructure deficit that the West faces in critical minerals is the result of decades of offshoring and underinvestment. Fixing it will require a decade of effort and hundreds of billions in capital. In the meantime, the squeeze continues. Now let us talk about winners and losers, because this situation is creating a dramatic redistribution of wealth and industrial capacity. The winners are obvious. Primary silver miners are printing money. Pan American Silver, First Majestic Silver, Endeavor Silver, Vizsla Silver. These companies have seen their market capitalizations explode as their margins expand. When your cost of production is $15 to $20 per ounce and the spot price is $94, the math is beautiful. Every ounce you pull out of the ground is pure profit after costs. The streaming companies are also winning big. Wheaton Precious Metals in particular has positioned itself brilliantly. They provide upfront capital to miners in exchange for the right to purchase a percentage of production at a fixed, low cost. When silver was $30, they were buying at $15. Now silver is $94 and they are still buying at their contracted prices. The leverage is enormous, but for every winner, there is a loser. The industrial consumers who have relied on cheap silver for decades are getting crushed. First Solar and Jinko Solar, the giants of photovoltaic manufacturing, are watching silver paste become a dominant line item in their cost structure. The transition to TopCon technology, which requires 50% more silver per cell than older technologies, has made them more vulnerable at exactly the wrong time. Their margins are compressing, their stock prices are suffering. Tesla is facing the same pressure. 25 to 50 grams of silver per vehicle might not sound like much, but at $94 per ounce, it adds over $150 to the cost of every car. Multiply that by the millions of vehicles Tesla produces annually, and you're talking about hundreds of millions in additional costs. Some of these companies are responding by trying to lock in supply directly. Reports indicate that major tech and manufacturing firms are bypassing traditional exchanges entirely. They are signing direct offtake agreements with miners, guaranteeing purchase of production at fixed prices for years into the future. They are willing to pay above spot just to ensure they have metal when they need it. This is extraordinary behavior. It tells you that the smart money in the industrial sector has concluded that the exchange system can no longer be relied upon to deliver physical metal. They are cutting out the middleman. They are securing supply by any means necessary. And this behavior, of course, only makes the squeeze worse for everyone else. The losers also include anyone holding paper silver through vehicles that cannot or will not deliver physical metal. Some ETFs that claim to be backed by silver have clauses that allow them to settle in cash during periods of extreme market stress. If you own shares in one of these vehicles, you need to read the fine print very carefully. When the squeeze reaches its peak, you do not want to discover that your silver exposure was actually just an IOU that can be settled in depreciating dollars. Now let us talk about what comes next, because the $94 print is not the end. It is a waypoint. UBS and other major institutions have revised their price targets upward. The consensus among those who are actually paying attention is that silver could reach a blow off top of $100 to $120 per ounce by mid-2026. The term blow off top implies a spike followed by a correction, and that may well happen. But the key question is, what kind of correction? Are we talking about a pullback to $80 before the next leg up, or are we talking about a crash back to $50? The answer depends on the structural deficit. If the deficit persists, any correction will be shallow and temporary because industrial buyers will step in to accumulate on every dip. They need the metal. They will buy weakness. If the deficit somehow resolves through demand destruction or supply increase or some combination, then a deeper correction becomes possible. But I do not see how the deficit resolves. Demand is being driven by policy mandates. Governments around the world have committed to net zero targets. Solar and EV adoption is not optional in this framework. It is required. As long as the green transition continues, silver demand will remain elevated, and supply cannot respond because of the byproduct trap. The math leads inexorably to higher prices. We are also seeing the emergence of backwardation in the silver market. This is a technical term that describes a situation where the spot price is higher than the futures price. In normal markets, futures trade at a premium to spot because of storage and financing costs. Backwardation is the opposite. It indicates that the market is so desperate for metal today that it is willing to pay more for immediate delivery than for delivery in the future. Backwardation is a screaming alarm signal. It tells you that the market believes physical silver available right now is worth more than promises of silver later. It tells you that the system is under stress, and the stress is getting worse, not better. The final piece of the puzzle is what this means for the broader financial system. Peter Schiff has been warning for years that gold and silver prices would eventually expose the fragility of the banking system. He's being proven right in real time. The 4.4 billion ounce short position is not held by retail traders. It is held by major financial institutions, banks, bullion dealers, hedge funds operating as market makers. These are systemically important entities. When silver was $30, their short positions represented a manageable liability. At $94, those same positions represent a crisis. The losses have more than tripled. Margin calls are cascading through the system. Some entities will be forced to cover, driving the price higher still. Others may seek bailouts or regulatory relief. The too big to fail doctrine may be tested in the commodity markets. We are entering uncharted territory. A commodity squeeze of this magnitude has not occurred since the oil shocks of the 1970s. The global economy is more interconnected now. The leverage is greater. The exposure is more concentrated. And silver is not just any commodity. It is essential to the technologies that are supposed to define the future. Solar, electric vehicles, artificial intelligence, semiconductors, 5G infrastructure, all of them need silver. All of them are competing for a supply that is shrinking. The green transition has been sold to the public as an easy, painless shift from fossil fuels to clean energy. Nobody mentioned that it requires vast quantities of critical minerals. Nobody mentioned that the supply chains for those minerals are fragile. Nobody mentioned that China controls most of the processing capacity. Nobody mentioned that the mining industry has been starved of capital for a decade. The silver squeeze is the first bill coming due for years of magical thinking. There will be more bills after this one. Copper, lithium, cobalt, rare earths. All of them face similar dynamics. Silver is just the canary in the coal mine, except this canary is not just singing. It is screaming. So what should you do with this information? I'm not a financial advisor, and this is not financial advice, but I can tell you what the logic suggests. Physical possession of silver has never been more important. If you do not hold it, you do not own it. Paper claims on silver are exactly that. Claims, promises, IOUs. When the system is under stress, those claims may not be honored at full value. Physical metal in your possession has no counterparty risk. It does not depend on a bank or an exchange or a government to make good. It simply is what it is. Second, understand that the spot price you see quoted on financial websites is increasingly detached from the real price of physical silver. When you try to buy actual metal from a dealer, you will pay a premium above spot. The premium reflects the true scarcity of physical supply, and the spot price is the paper market. The premium is reality. Watch the premium closely. If it keeps expanding, that tells you the squeeze is intensifying. Third, understand that this is not a short-term trade. The forces driving this squeeze are structural and will take years to resolve. New mines take a decade to develop. China is not going to reverse its export restrictions. Industrial demand will continue to grow as the green transition progresses. The deficit will persist. This is not about catching a quick move and flipping for profit. This is about positioning for a multi-year repricing of a critical asset. Fourth, understand that the mainstream narrative will try to gaslight you. They will call it a bubble. They will predict a crash. They will compare it to Tulip Mania and the Hunt Brothers and every other speculative blow-up in history. They will do this because the alternative, admitting that the system of paper promises has failed, is unthinkable to them. Do not be swayed. Look at the fundamentals. Demand exceeds supply. The deficit is growing. The vaults are draining. The math does not lie. Finally, understand that you're watching history unfold in real time. The breach of $94 is not just a number on a screen. It is a statement. It is the market telling the world that paper silver is not the same as physical silver. It is industrial users telling exchanges that they need metal, not contracts. It is China telling the West that the era of cheap critical minerals is over. It is Peter Schiff's decades of warnings being validated in the most dramatic way possible. Silver has been called poor man's gold for centuries. That name is obsolete. Silver is now a critical strategic metal essential to the technologies that will define the 21st century. Its price should reflect that status. And it is beginning to. We are watching in real time as silver transitions from commodity to strategic asset, from ignored to essential, from cheap to dear. The $94 price is just the market catching up to reality. How much further it goes depends on how long it takes reality to fully assert itself. I suspect we have a long way to go. Thank you for being here. Thank you for watching to the end. If you found value in this analysis, hit subscribe. Leave a comment saying "stacking through the storm" so I know you understand what is happening. Share this video with someone who needs to see through the mainstream narrative. The weeks and months ahead will be volatile. There will be pullbacks. There will be scary headlines. There will be moments when it feels like the squeeze is over. Do not be shaken out. The fundamentals have not changed. The deficit remains. The short position remains. The industrial demand remains. Stay focused on what is real. The metal in your hand, the structural forces driving the market, the mathematics of supply and demand. Everything else is noise. I will see you in the next one. Stay sharp. Stay stacked. and as always, see through the noise.